All right, great to be here, Portland. If you remember us from last year, if anybody was here for the May 2024 Bitcoin, it's for everyone. Show of hands, who was in the room? A lot of familiar faces. How about new? New to Bitcoin, period. New Bitcoiners. How about class of 2024, class of 2025? All right, that's good. I just wanted to get a sense of if we're talking to new blood as opposed to the diehard Bitcoiners, hold your own keys, all of that. So for intro, we've got Andrew Edstrom on my left, financial advisor, author of the book Why Buy Bitcoin, which is on the shirt. He'll be signing copies later in the hall. And Jeff Walton recently took a role, left the fiat reinsurance world, and has joined an asset manager, Strive. So that intro's out of the way. I'm Matt Dines as well, run a firm called Build Asset Management up in Seattle. Also should introduce myself. So to get us started, I want to talk about just the general market context we find ourselves in July 2025. If you remember back last year, we were in a bull market still, right? And I looked at the price last time we all met. It was about $70,000. It was an all-time high. We had the spot Bitcoin ETFs out. Now, obviously, we've broken through the $100,000 mark. We've traded there for 60 to 90 trading days. It seems like we're getting comfortable at that level. I think next thing on the horizon I wanted to talk about, what do you guys see in this next 6 to 12 month outlook for Bitcoin itself?
You want to start?
Sure, happy to go. Yeah, so that's really good framing, giving us a lay of the land of where we were a year ago. And personally, I think the architecture of the market has fundamentally changed. We've got significant corporate allocations to Bitcoin. The Bitcoin ETF was the most successful ETF in history at a pace faster than any other ETF on record. So first of all, you've got this change in structure with the Bitcoin ETF. Now people are able to go in, buy Bitcoin in a brokerage account, and stay within a traditional financial ecosystem. And looking to where we are today, there are now new financial instruments backed by Bitcoin, primarily from Strategy and all these other Bitcoin treasury companies that are offering Bitcoin-backed securities. And you have an entirety of a evolving and developing risk curve with different risk return metrics that are backed by the power of Bitcoin. So like the nuclear core of these underlying securities. And what I mean by that is you can now, through Strategy's perpetual preferred offerings, you can now access Bitcoin-like upside with reduced downside payable via a dividend. And there's now 4 of those instruments out in the market, and there's significant opportunity for other players in this landscape to go offer similar instruments. So in my mind, this market is evolving incredibly fast, and I think at a pace that should be expected, and it will continue to evolve into the future. So in my mind, if you think about where we go from here, this is very different than 2017. This is very different than 2020. You have new instruments that can be used in different market conditions that never existed before. So I think the plumbing is fundamentally different than what it's been like in the past. And here comes Andy to be the wet blanket.
That's me. So any Disney fans out there, all you dads out there, I brought my 4-year-old's Disney princess blanket. And that's just in case I have to be the wet blanket on this conversation. I was expecting more moon on the intro there. But and by the way, lest people accuse me of not being bullish enough, in 2019 at 3K Bitcoin is when I started writing Why Buy Bitcoin, and the price target was 10-year target 400K. So we're well on our way, but we're not there yet. I have to agree, the market structure has obviously changed, and I can speak personally to that as a wealth manager. Like, my clients own the Bitcoin ETF. They did not own the Bitcoin ETF when it wasn't an ETF. They owned that gnarly grayscale product, among other things, the trust. But it's clear that financial advisors, wealth managers are slowly doing their homework. Some of them are looking at it as a long-term accumulation for their clients. And as such, with a mandate to rebalance toward the target, they accumulate over time. They should be sellers when price goes way up, and they should be buyers when price goes way down. So I think that is a fundamental market shift. The other thing I'll say though is I'm paying attention to some other market signals like general froth in equities. I think of these meme stocks popping off. I think of the quantum computing stocks, like multiple companies with multi-billion-dollar market caps that don't seem to have a real product, and so I'm still dancing on this bull market, but I'm dancing a little bit closer to the door.
So you mentioned an interesting word there, froth, right? And froth is one of those things that might be hard to define. I think it's one of those things, we know it when you see it, right? Just pure speculative garbage, and we can all foot back to 20 to 30 years, everybody in this room, well, maybe I'm aging myself, but we go back to, the dot-com bubble days, and you had like sock puppets on the Super Bowl, and it's obvious in hindsight that there's froth, asking people to sign up for a dog food app in the year 2000, right? The market just wasn't ready. But in the context of today, yeah, there are some equities out there, as Andy mentioned, that would qualify as froth, but how do you know? Like, what's the difference between ICO scams in 2017, pure froth? Some have described Bitcoin as a bubble. How do you know in hindsight? Even the strategy securities, like you could see, follow-on corporate players trying to mimic that, issuing their own debt instruments. Where do you draw the line as in the wealth management industry? And is the financial advisor or the institutional investor able to separate Bitcoin, as the wheat from the chaff, in your experience?
Yeah, that's a multifaceted question there, so I'll just give an answer to it. So the way that I definitely see what you're seeing, Andy, in the market, right? You see froth in different locations. You look at a company like Palantir, and they've got a 675 PE ratio. You look at some of these other stocks that seem to have no practical reason for their valuation, and you're seeing it in ICOs, you're seeing it in meme coins and all of these other things. And to me personally, I take a very strong risk perspective with the whole market. My background in reinsurance, I'm thinking about risk 24/7, 365. I see a spectrum of risk when I look at the marketplace. And when I think about what a shift away from froth, what that might look like, I think that market structure is different than what it has been in the past. Like when people have left NFTs, or they left, shit coins for all practical purposes, and they left, stocks when things were too frothy, they went to dollars. And we're now in a room full of Bitcoiners, and they now have options to have low vol exposure to Bitcoin without having to go to dollars. And that hasn't existed before, and those that structure is just fundamentally different than where we were in the past. So what will it look like in the future? I'm not 100% sure, but I can see a scenario, and maybe it's not this cycle, maybe it's a future cycle, but I can see a scenario where there's this risk-off moment in the market, and the risk-off moves to Bitcoin. So
I look forward to that day, and I think I always feel like we're one cycle away from that. And I've probably been early on that. I probably thought that last cycle. But I have to concede that the market structure's changed. I think the other thing to consider is, let's zoom out, consider the big picture. Like Bitcoin is at least digital gold, okay? What is the gold market today? 20-ish trillion. Okay, is Bitcoin undervalued still against gold on a long-term basis? Yes, way, way, way undervalued. And so when I think about, froth in the market, I think about liquidity flows, and I'm sort of guessing like, oh, do we get a bubble in general in assets? By the way, if we're nowhere near the .com level, in my humble opinion, so it's like, do you want to own the bubble? You don't want to own the bubble at the end, but you definitely want some exposure before the end, because otherwise your clients will fire you because you're not making them money. But with respect to Bitcoin, severely undervalued still, has not even remotely realized its potential. So does it make sense to accumulate over time? Absolutely. And then also, should you expect a downturn at some point? Also, absolutely.
Yeah, that brings to mind a George Soros quote in his book, The Alchemy of Finance. When I see a bubble, the first thing you do, spot it early and get in, right?
Love that.
So I think, Jeff, something you said interesting in your response, the kind of prevalence that's mushrooming in the market of securities that provide a kind of a muted, if you will, risk return exposure of the high volatility that's kind of embedded in the spot dollar to Bitcoin market. Question for the institutional finance professionals: do they actually grasp, or how much do they appreciate kind of the core of what Bitcoin is, which is private keys interacting with the network for ultimately ownership of the 21 million UTXO set? How do you square that?
The market doesn't get it. The market is not there. The market doesn't get it. The market doesn't understand Bitcoin. I had calls this morning with people that work in the space. The market largely doesn't understand Bitcoin, and this is a legacy problem. Like, the infrastructure of the traditional financial market is the same way it's been for 60 years. And these people have gone to business school and they've been told volatility is risk. And now you have a new asset that's come to the market that's volatile, but people aren't seeing it as risky. And so the majority of the traditional financial market hasn't grasped this changing dynamic of volatility not meaning risk. And I think the market at large is starting to grasp that a little bit. But I think absent this institutional perspective, it's really hard to explain to most of the retail world how to use Bitcoin. Kind of like what you're explaining, right? Okay, so you're going to take this money and you're going to put it in an exchange. Okay, and the exchange is going to give you Bitcoin. And then you got to take this Bitcoin, you got to send it to a hardware wallet, and these numbers represent your keys, and you can't lose these numbers, and you should probably want to split them up and maybe spread them geographically and actually work with this company over here to do a multi-sig. It's just super complicated. It's a hard story to tell. I personally hold Bitcoin in cold storage for myself, and I'm sure most of the people in the room do. But the reality is 99.9% of the world isn't going to pick that up, I think. And the access to these alternative vehicles, particularly the retail crowd, but the institutions to get this type of exposure, these instruments are outperforming every other instrument in the market with significantly different and less risk profile. And I think this is the Trojan horse for bringing that institutional capital in the door to recognize the value.
So with these new institutions coming into Bitcoin, you've kind of said, by and large, yeah, sure, within, a Goldman Sachs, within a Fidelity, well, especially Fidelity, a lot of people get Bitcoin at Fidelity. But, at your, household names, broadly speaking, it's still very early in understanding the technology, how to actually custody. And my question is, given every cycle in Bitcoin, we've had to go through a phase where some institution or party had to completely trip on the pavement, faceplant. And go back 2012, Mt. Gox. 2017, I'd say it was not on the Bitcoin chain, but it was on like the ICO area of the economy, those investors. 2021, 2022, we saw it happen with FTX, the dollar decentralized lenders, BlockFi, Celsius, et cetera. Why this time? Do you think, with those experiences, watching Bitcoiners trip over themselves, mishandle the the precious, sword, right? And everybody falls on it at some point, every cycle. Why is this time different with the institutions?
1/3 of the world's money is in fixed income instruments managed by fixed income money managers. They are never going to buy Bitcoin ever. It's not within their mandate. They can't do it. And so you need a way to communicate to them in a wrapper that looks familiar to them that they can buy. And now that exists. It's an innovation that hasn't existed before, and now it exists. And I think that's how this capital is going to come in the door. The reality is they're just never going to buy Bitcoin. They can't.
That wasn't exactly the question. It was, how do they not trip over themselves with a new kind of expansion into another capital swim lane?
Can I maybe jump in? Yeah, I think first of all, there's always risk, right? I mean, we look at all the ETFs, we look at the strategy, the various copycats. Like, where are the coins, right? I think they're still mostly at Coinbase for the most part, and that's a real big honeypot. Coinbase, we believe, has been secure. Actually, I think they were compromised at one point very early on. They didn't lose a lot, so they've been mostly secure for a very long time. Will they stay secure? When I think about risks to institutional adoption, something bad happening in Coinbase, that's like number one, right?
It's a national security risk at this point. If something like the way I view this, you've got each regional block. Like we're in a multipolar world. This is institutional finance talking. We'll throw some macro talk up here. We're seeing the world split into what I'd call 4 regions, right? You got the U.S., the Western Hemisphere, you got Europe, you've got Russia, and you've got China. But each one of those has their own crypto exchange. That's kind of their flag bearer, right? In the U.S., it's Coinbase. In the Europe, UK, it's OKX predominantly. China, Southeast Asia, it's pretty much Binance, right? And then Russia has, I don't even know what the Russian Bitcoin exchange is. We don't need to know. We're not going to be allowed to deal with it. It's on a sanctions list. Don't even worry about it. But yeah, from each one of those, like if you centralize and you focus on one honeypot, like how big of a concern is the Coinbase specific risk for institutional?
Yeah, the answer is it's a big concern. I mean, there are, we think, solutions for managing keys. Like Coinbase from back in the day was using Shamir's to shard key material. Okay, I don't know if they're still doing that anymore. We have obviously native multi-sig. We have multi-institution multi-sig. That can be a helpful solution. Also, all these new solutions are just that. They're like kind of new. I mean, you're a fan of custody history, I know, Matt. I mean, how long did it take to develop safe custody of gold?
Oh man, you start with goldsmiths and it just organic, and there is no safe custody of gold. Like that's I mean, you could
point trick question, right?
Yeah, there's it never worked, and that's why we didn't get up here to talk about gold, but gold failed as a money to build credit layers on top of it for specific weaknesses embedded in gold. It's hard to move is the key one, hard to audit, hard to verify, but does Bitcoin get around those?
Yeah, I think a good piece of news is the fact you highlighted, which is every down cycle, every big bear market, Bitcoin winter, crypto winter, whatever you want to call it, there were bodies that floated to the surface. And maybe if we have another bear market and there aren't any bodies that float to the surface, that'll be a good indication that we've, quote, made it. And so, is anything in the world ever 100% safe? No. But I think a down cycle where nothing major blows up would be very helpful to institutional confidence.
Well, we say those two things, a bear market, right? Those are actually, speaking to like the Austrian business cycle here, those are synonymous. Like you need the bottom of the cycle to wash out bad practices, bad businesses, things that society just no longer needs, right? So it's a coaling point, and there will be bodies brought to the surface. There's no way to avoid it. It's survival of the fittest. It's ecology, Darwinism in action.
Yeah, on this topic of risk and security of custodians, it's a fascinating question, right? One of the things I think about is the comparison of risk in the rest of the market. Like, is that risk less than physical risk? like, what does the rest of the bond market look like? Is digital risk a better right than physical risk? I'd argue yes. And so I truly believe that risk in the entire market is mispriced everywhere, and it's getting recalibrated. And I think we're in this kind of recalibration period. It's probably going to last a decade, maybe 15 years, but the evolution of this space and that concept it's important to work through.
Just to underscore this point, so one of the things that I learned in recent years was the difference between a margin account and a non-margin account at a normal custodian, like Schwab, Fidelity, what have you. And they have different levels of risk, and these custodians love to rehypothecate. They love to take assets and do fun and interesting things to make money with them.
That's the business model.
That's it. That's the business model.
Feature, not a bug.
That's it. That's how they make their money. And so, yeah, is there rehypothecation in the system? Absolutely. You know, are your shares, which are a electronic claim against a paper claim? I can't remember if they did away with the paper at the TCC.
Oh, that's been gone for 30, 40 years. Yeah, the DC, I don't know, maybe we'll give the audience hopefully some new knowledge here. Yeah, technically all of your shares that you hold at your broker-dealer, your Fidelity account, your Schwab account, et cetera, you don't own the actual things anymore. The way this used to work, say your great-grandfather bought a share of Disney back in 1930, whatever, he put it in his vault, right? And that share certificate was your actual ownership. That was the asset. It was a bearer asset. That's all changed. It started in the 60s, 70s as electronic ledgers just had to take over. Like, it's just so much more efficient to run a ledger electronically than.
Didn't they shut it down for a week or something to clean it up in New York to get everything?
We're not going to go into that conspiracy theory. Let's not go down that rabbit hole. But yeah, so the way your actual share certificates work now, you actually hold an IOU against your broker-dealer, against Schwab. They owe you one share of Disney now, a digital representation of a share. But it's actually the DTC, the Depository Trust Company, that owns all the shares of every public company. And then it's the broker-dealers who then kind of have claims on those shares on behalf of their clients. And that's where you get into like short interest, fractional reserve. There's no good counting. Like, you've seen this in specific cases in the past where a corporation kind of has its own ledger on its own balance sheet, tracking of the shares outstanding, but then actually identifying, hey, how many shares are actually out there long? Maybe more than the number of shares that actually exist. So we're getting into
Dole Foods, right? Dole Foods had like
yep.
10 or 20% more shares or claims against their shareholder count, their share count, than actually existed.
So this is where, we're going down a deep rabbit hole, but hopefully you're learning something about the financial system, how it actually works. It's turtles all the way down. And then when you anchor to Bitcoin as your hard ledger, like, that's what the problem is actually solving. Everybody can adopt, and take part voluntarily into this consensus mechanism. You hold your keys, you know exactly how many Bitcoin UTXOs that you have possession or control of, and you know the money supply at any given time. So it's, just a hard ledger, right? Public, open. And I think the point we're getting at here is institutions are trying to port over this old system, which is fractional reserve, like, at every level. That counts the actual dollar system with bank deposits, the financial layer, and it's even how the exchanges and broker-dealer network wrapped around exchanges is built today. And kind of my question is, if we're looking at this, we say, all right, how many professionals in institutional finance actually grasp this, how things work under the hood? Is it 1 in 100? I'm doubtful on that. This stuff's not on your CFA curriculum, right? Is it 1 in 1,000? Is it 1 in 10,000? How many of them understand Bitcoin and what it actually is? And I don't know. I'll be surprised if we don't see a cycle where someone somewhere, institutions, didn't make mistakes and trip over yourself. So
agreed. I
prepare for that.
Can attest. It's not on the CFA curriculum. It's not on the CFP curriculum. Another thing to point out, nice thing about a bearer asset is it is comforting that, notwithstanding that Disney share, is floating around in the ether, I can take comfort in my physical Disney princess blanket.
Hard assets.
Hard asset. hard asset, tangible.
They'll keep you warm. Okay, so we're talking about risk and where the risk actually lives in Bitcoin, right? We see the volatility in the Bitcoin price. The measurement of Bitcoin, though, the way I view this, there's two dancers tangoing there. There's Bitcoin and there's the dollar. I think most of this room has their head wrapped around Bitcoin, right? The credibility guarantees that Bitcoin offers, right, in terms of block issuance, money supply, all of that, all the way out to the year 2140. Dollar, right? The dollar is where a lot of the volatility is coming from. And we're looking at a dollar that's based on a credit liability money, a monetary framework that's boom and bust. And the way that risk materializes is through leverage, credit creation in the system, people borrowing out in the broad economy, issuing debt, et cetera. But I think, this has been around for 10 years at this point, people borrowing against their Bitcoin. We're now to the point where, all right, every cycle it's going to grow, another order of magnitude, maybe two, right, and proxy Bitcoin price growth. But I think this takes the discussion to the logical endpoint, which is leverage in the system. How do we know when there's too much leverage on the Bitcoin collateral layer?
Yeah, that is the big question. I wish I had a clear, indisputable answer to that one, Matt. I think that obviously you can look at just sheer nominal numbers. I mean, and you can compare to the fiat system. You can say, what's the embedded leverage in fiat? How many times has that?
Yes.
Yes. The answer is yes. How many times have they rehypothecated that T-bill? Many, many, many times. In truth, we don't really know. So that's one benchmark that I look at is relative to fiat, and fiat is insanely levered. Who knows, hundreds of times. The banks themselves, which used to be levered 40 times before the GFC, okay, now they're only levered 10 times, except a lot of that collateral that they pass around, gets relevered. Okay, so that's one benchmark. I think another. And by that standard, by the way, the leverage level on Bitcoin and even crypto arguably doesn't look that high yet, right? If Bitcoin's a 2 and change trillion asset, and yes, unfortunately, Bitcoin is still linked to crypto because most of the businesses that touch Bitcoin also touch crypto. And they have leverage events by themselves, like we saw with the blowups in the last cycle. So it's all relevant. But let's call that, several $1 trillion of quote unquote asset. I don't see leverage levels. I don't have aggregate numbers, but I don't see numbers that are very high against that collateral at all. I am watching it. I'm observing. Part of the question I've asked myself, and Jeff, I'm sure you'll comment on this, is like, why are so many coins pouring onto these corporate balance sheets?
That means your time is up.
The show's over. And why is so much money pouring into ETFs? And part of the answer is that it is actually very expensive, right, to borrow against actual Bitcoin collateral, and the terms are not fantastic against normal terms you'd expect in a functioning credit market. But now you put it in a paper wrapper that's in a Schwab account, and magic happens. It's
been de-risked.
That's right. I don't know if it's been de-risked, but it's definitely more leverageable. And so I'm watching closely, to see how that market develops and how those leverage levels develop. But generally speaking, I don't think the leverage is that high yet, but it's trending up.
Yeah, I agree with you. I'm kind of viewing this whole landscape holistically. And in cycles past, you had leverage was taking place via commingled exchanges across multiple coins, leverage in multiple different directions. So you may take, 20% leverage on Bitcoin at FTX and then go lever that on Ethereum in 2x and then go, join that to a lever over on Fart coin over here. And then that just, built a ton of leverage into the system. And I think when
DeFi,
yeah. And, I think when FTX collapsed, I think they were, 120, 140 leverage, so maybe even higher than that. So they just had more outstanding liabilities than they had assets, which is what, how the whole thing blows up. And now looking at the evolution of these corporations that are adopting a Bitcoin treasury standard, everything is incredibly transparent because of the SEC, right? Like all of the debt that they have, you can go look at the debt. You could go look at the terms of the debt. You could look and see how it's structured. You can understand, what is the risk vector here for any of these different instruments. And as this market evolves, there are some companies that have taken challenging terms on some of the debt that they have, but they also have 4-6 year durations on them, so that they have the ability to sit and withstand cycles which have historically played out really well for the folks that hold Bitcoin. And you look at the relativity, looking at a company like Strategy, they've got $8 billion of convertible bond debt, 5 of which is trading in the money, is basically equity, and they've got $6 billion of preferred equity outstanding relative to a true $2 trillion asset and a company that's got $70 billion of capital on their balance sheet. So when I see leverage in the market, I think there's significant room to grow the leverage in the market within the corporate ecosystem. The big question becomes, is there significant leverage on these DeFi exchanges that we're unaware of, or individuals that have levered Bitcoin in inefficient or unsustainable ways?
Awesome. Well, thank you, guys. Let's open it up. Hopefully some questions from the audience.
You brought up leverage. I've heard that in the traditional markets like oil and gold, the derivatives really are orders of magnitude bigger than the spot markets. And with everything that's happened in the last year, it seems that the derivatives around Bitcoin ecosystem have been growing quite a bit. And I'm wondering what your thoughts are on how big has that gotten and how much is that impacting what we're seeing in the price?
Do you want to take that? I can do a little bit on the CME futures. So for the U.S. market, the 2017 launch, like we go back in history, the CME launched a cash-settled Bitcoin futures contract, which goes out essentially 12 or 13 months into the future, and you can basically hedge out your risk. You can speculate as well if you want long or short futures with leverage, but you're not actually buying Bitcoin itself. In futures, what you're actually measuring in terms of like capacity, it's called open interest. It's like how many contracts are out there. And in the U.S. markets, there's not actually that much volume on CME. It's growing. It's a fast-growing market, but in terms of capacity behind that product, it's still pretty small. Maybe like 10,000 contracts outstanding at every month's maturity. And then, I mentioned they go out up to 12 months. You could buy that future. It's technically listed. A lot of times there's no bid ask, there's no actual trades, there's no volume taking place outside of maybe 2 months out. So the way I view the futures, the derivatives market in Bitcoin, at least in the US, it's really for the market makers. They're taking on Bitcoin, they're taking Bitcoin in inventory, but their business isn't to treat Bitcoin as a balance sheet asset. These aren't Bitcoin treasury companies. They're in it to trade. They're market makers. And they're using these products to hedge out their risk. So I think in the US specifically on CME, you're not seeing like the froth, if it is in the market, it's not showing up there, like with the dealers and the liquidity and the counterparties. Now, if you look at options and derivatives, like this is where you've seen options go live on IBIT. You've had deep options activity, like full chains, and very liquid in the Bitcoin equities, especially MicroStrategy. There's a lot of leverage embedded in the equity related Bitcoin options, but in terms of risk, usually the hedging is taking place between the dealers. They're shorting stock or buying stock long to hedge out the calls and puts that they're selling. It's a tough question to answer how much risk is actually embedded, but that's where the price is actually materializing from at the end of the day. It's through the dealer activity. So yeah, I don't know. I don't know that there's like crazy Bitcoin swap lines under the hood. Like I haven't heard any headlines about, ISDA contracts, cross-border Bitcoin to other foreign exchange swaps. And at the end of the day, there's not going to be any central bank, swap line to bail out participants on Bitcoin, shorts. It's going back to the going back to the roots, what's the point of Bitcoin? It's like chancellors on brink of second bailouts of banks. There are no bailouts here. And if that derivatives exposure does get built up, it'll have to get rinsed out, and it's going to have to eat it the hard way. So that's the difference of Bitcoin versus the legacy central banking model.
Can I just add on the bright side too? The changes in regulation now are huge for this in a positive direction, in my opinion. Those of you who were around during COVID and watched Bitcoin go from 10 to 6K and then nuke to 3K in one night might know something about an exchange called BitMEX, which, according to legend, basically was just cascading liquidation after liquidation after liquidation in a short period of time. And the rumor is that management, Arthur Hayes, et cetera, at the time literally pulled the plug so that Bitcoin wouldn't go much lower, than a whatever it was, 45% down day, at the depths there. Okay, so was BitMEX a size player in the market at that time? Yeah, arguably yes. Now, with regulation moving forward, it seems a lot more of the whole industry is going to be brought within the regulatory tent. That means the Wild West is probably going to be a little less wild. The leverage is going to be a little bit more visible, hopefully, and that may reduce risk. We'll see.
Time will tell. All right, another question?
Hi there, yeah. First of all, thanks so much for being here. This is awesome. Apologies for the question, slightly off topic from what's on the screen here, but one of the OG Bitcoiners, John Vallis, many of you guys will know him. I used to love the questions he would ask people. It was kind of more to kind of how Bitcoin changes you, and I couldn't think of three, better people to ask, the three great gigabrains on the stage here. I was wondering how Bitcoin has changed you. It offers us a really long kind of time horizon, and I think that tends to change us as people and how we think about the world and think about ourselves. So that's the first question. And the second question is, the way I look at it, Michael Saylor has this idea, okay, well, we have $900 trillion of stuff in the world, and it seems to me that it seems to him that there's 450 trillion of it is monetary premium, and the Bitcoiners are sucking up all of that monetary premium. And I think that with that comes a great responsibility. And I was wondering if you guys could talk to a little bit of the things that we should be thinking about as Bitcoiners and as a community about what kind of massive responsibility that is to be basically the inheritors of all this capital.
Just
I'll be really short. Before Bitcoin, I would not have had the stones to bring my 4-year-old's blanket and wear Crocs on stage at a conference. So that's my answer.
Bitcoin fundamentally changed my life. How I was operating in the world, I didn't have a lot of hope for getting to where I wanted to be in my life. I was working in the traditional financial world for a decade. I was working harder and faster and not going anywhere. I didn't feel like I would get pay increases, but just felt exactly the same. I wasn't moving anywhere. And so adopting a Bitcoin standard for myself and fundamentally flipping the world I saw upside down and seeing things through a different lens changed how I view the world, and has changed how I communicate finance to the financial world.
Hey guys, good to see you. Really quick, as you know, Bitcoin is a trustless protocol, right? And with the financialization of Bitcoin, an increasing level of trust is required. And despite the benefits that these BTC treasury companies bring in terms of increased adoption, do you feel that it's part of your responsibility and role to keep these companies accountable? Because if you look back in history, the greatest source of risk is actually these third-party institutions who have lost Bitcoin for many people. And if you do feel like that may be part of your role to keep these BTC corporations accountable, how would you do that?
So I'll just say, in one respect, the mission for me personally, hasn't changed in, 6 or 7 years, right? Which is trying to help people understand what Bitcoin actually is, including actual, control of UTXOs, private key management, cold storage, all that stuff. And that will be a struggle for the foreseeable future. I probably would have said a few years ago, oh yeah, we're getting this right, we're winning, people are understanding, they're doing it. And I wouldn't go to 99.9%. I think you said Jeff would not adopt cold storage. But you know, it's an uphill battle. So for sure, everyone here in the audience needs to do their part, help people understand the difference between real Bitcoin and paper Bitcoin.